Hey, welcome back to the Synergy. It's good to have you back here. It's Dr. Olotu-oke here, and this is Insurance, Finance, and You. Okay, so during all this period, what I bring is I bring answers to some of the questions that I get through my consultation, through some of my team's consultation, and it's just for you to understand some of the lingo that we use within the insurance and finance world. So today, there's been a lot of concern about the cost of living and inflation. And before now, I'll say last year and 2 years ago, inflation wasn't really a big deal. Like nobody was talking about too much. But when inflation hit 10% this year, we knew we had to do something. So presently, how can you protect your insurance payout against inflation? And that's what I'm going to be talking about today, because quite a lot of my customers have had their policies reviewed and protected against inflation. And so I'll tell you about 3 types of policies, all right? So when you're putting on your insurance in place, so let's talk about the life insurance that you're very, very familiar with, because I think everybody knows about life insurance. But very, very few people understand the power of income protection, which I'm also going to delve into a little bit. But so let's focus on life insurance first. All right. So peradventure, you have a life insurance, let's say for £100,000. So you put it in place about 2 years ago. All right. And life happens. Maybe you have that policy for about 20 years. As at the time it's going to be due to be paid out, obviously £100,000 as at then may not be able to have the buying power that I would as at, like I had like 2 years ago. So that's the effect of what it can be if you have to like go on a level term. So 3 types of life insurance. One, you can have it as a decreasing cover. The second one, you can have it as a level cover. And thirdly, you can have it as an increasing cover. Now, let me tell you how relevant all of that is. So when we talk about decreasing cover, so for example, and that's very, very, very common when you're protecting your mortgage, because or any kind of debt. Maybe you have a business loan and every month you're paying down. You also protect that risk against you dying. All right. So every month, the premium is much cheaper than a level cover. So any debt that you have that is reducing on a monthly or a yearly basis, the cheapest way to cover it is a decreasing cover. So if you're watching this and you have a mortgage, you'll see some of that says decreasing cover. All right. So decreasing cover, whether it's covering your mortgage with life insurance or covering it with a critical illness cover, which is a better way. We'll talk about that later in another video. All right. So a decreasing cover is relevant to a debt that you have that is reducing in value over time. So for example, you have a mortgage and it's for 20 years. In the 18th year of you paying down, life happens. So if the mortgage was 100,000 as at the time you took it out and you paid for 18 years, maybe the last 2 years debt occurs, right? And that needs to be paid back. The insurance company will only pay out what is outstanding. So let's, for example, from £100,000 mortgage, you now have £10,000 remaining over the last 2 years. Insurance company will only be liable for that £10,000. That is the decreasing cover, okay? Which in most cases, the premium is much cheaper. Now, the second way to cover your risk is a level term, okay? Level term cover. All right, a level term cover is the second one. And that means that if you take out £100,000 right now, and it's for a 20-year term, that occurs in the 18th year, all right? They will still pay out, the insurance company will pay out £100,000 to your family, right? To maybe cover, maybe children need to finish school, maybe they need to have that amount, some amount to start buy the first property, have the deposit for the first property, whatever it is, we cover funeral and all of that. So 18 years, you paid your premium. Instead of £10,000 that's outstanding in your debt, if it's a decreasing cover, for the same £100,000, they'll pay that exact £100,000 to your family if it's a level cover. Now, the third way and the best way to do it right now is to have an increasing cover. And then let me explain that to you. So everybody's talking about the cost of living and everything has risen so astronomically, it's almost ridiculous, right? As of last year, if we're eating your house with electricity of about £80, right now you're paying almost £300. Like, how do you account for that? So If you were to take the same £100,000 and over 20 years, okay, then of course in the 18th year, what increasing cover will do is it's going to adjust it to inflation and pay out what is relevant to that period to your family. So you took out £100,000 in 2023, and then of course in the 18th, in 18 years time, if the relevant amount that will buy what needs to be bought in that period is £150,000, that is what will be paid out, not the initial £100,000 that you took out. But the implication there is every single year, the insurance company will write to you, do you want to accept this increasing? All right, so they will adjust to that inflation. So let's say, for example, inflation is about 10%, all right? Your premium will increase maybe about like 50p, maybe lesser than £1, all right, for monthly. And what they will do is your payout amount also increases at that rate, all right? So the premium increased a little bit, almost negligible, which I think matters right now because the inflation is now becoming a very, very big conversation. Most people just ignore it before because it wasn't really a lot, but right now it is a lot. So for an increasing cover, your premium will increase slightly every single year, and also your payout, the lump sum payout will also increase accordingly. So let's say, for example, your initial premium was, let's say, £50. Next year, you will have a letter by the insurance company that will say, okay, yeah, are you happy for us to adjust this for you? And your premium will now be maybe £50.50, okay? And then your payout amount will also increase slightly. Maybe instead of £100,000, it's now increased to £110,000. Does that make sense? So right now, if you're watching me and you want to go and check your policy, if it's a level cover, I think it's high time that we reviewed it, okay? Because it means that, like, let me go over the three things I've said. If you took out £100,000 in loan for your mortgage over 20 years, every single year it's reducing. That's a reducing cover. It's cheaper to cover. In most cases, you have a debt, you have a loan, you have a mortgage, you use that. Level cover, if you took out £100,000, if that occurs in the 18th year, they pay out exactly £100,000. But if you have an increasing cover, it will be adjusted every single year to that inflation. It's called retail price index, all right? And whatever percentage that you've agreed with the insurance company to adjust it to, it adjusts to that. But the premium difference is almost negligible, but helps you to keep the integrity of the amount so that it is relevant to when you want to, when it may pay out. And I always say to people that insurance is your backup plan, all right? Just like the plan A is for you to go out, do your job, make your income. However, what could stop that income from coming in? It could be death, it could be illness. What happens if that ATM does not churn out the cash that normally to churn out to your children? Insurance comes in. So if you're watching me now, you don't have any financial protection in place, oh my God, you are living so dangerously, because there's no how you can drive out a car in the United Kingdom today without having insurance. So how would you have the biggest asset that you have, that your family has, and you're living dangerously, no protection? So we need to be having a conversation. So send me a personal message, text FINADVICE to 074-1185-7200. I'm going to put all the details here. So if you're watching this, you want to go and check your policy, all right? If it's a level cover, then I think you should have a conversation with me so that we can fortify you. There are different school of thoughts. You can decide, Dr. I just want my premium to be exactly what I want. It's fine. If you have 100,000, whatever time that risk may crystallize, £100,000 goes to your family. However, it may not be enough to sort out the things that needed to be sorted out at that period because of inflation. So it's really good for you now. Let's look at it. For a lot of my clients, we've actually reviewed it. I wasn't too fussy about, having an increasing cover now, but right now, with that inflation, it just makes economic sense for you to do that right now because it's not a lot. And okay, here it is. So when we review your policy and we'll make it an increasing cover now, it does not necessarily affect your premium right now. It will affect in the next year, but you will have a notice If you don't want to take it up, it's fine. You can just reject it and it's going to keep it as a level. It's going to downgrade to a level cover. If you reject it like 2 or 3 times in a row, you lose the ability to be able to add that to it back. So it doesn't affect your premium right now, but until the next year. So you have 1 year to sleep on it if you want to take it up or not, but we need to put it in now. So let's have that conversation. So what we talk about, increasing cover is the best way for you to cover yourself against inflation right now, so that whatever policy you have put in place to cover your family, it is relevant to the period that you may need it. All right. Now let's talk about income protection. Income protection, if you have income protection in place and you don't even know what income protection means, all right, so this is the simple thing about income protection. It gives you monthly salary if you're unfit to work. Now, unfit to work does not mean that you lost your contract. All right, we don't have that right now. I think that since post-COVID, that's been put on a hold. That's unemployment cover. If you had it before COVID, yeah, praise God, it's still live. But there are no new ones in the marketplace now. Maybe in a few months, another year, it may come back. I can't, don't quote me, I can't promise you. But if you were to be ill, or maybe have an accident, you were stressed, you got fever, a backache, anything that could stop you from working, from earning, right? Then you have an insurance coming in to pay you for up to 2 years or even to retirement, right? And the beautiful thing about it is you can claim multiple times all through the time that you're working. So you know what? Let's talk about that. And also we'll make it an increasing cover to make sure that anytime that crystallizes, if that crystallizes, and honestly, income protection is one of the most paid in the UK, most claimed, right? Because people do fall ill and people don't just die anyhow in the UK right now. But income protection, they say income is king. The first thing that you need to put in place is your income being protected. So protect your income, because that is the number one thing. If that does not come in, unfortunately, you may not even be able to afford to pay for your life insurance. So let's protect that income to make sure that if anything happens to you and that income is not coming in, you can actually get paid for up to 2 years, some up to 1 year, some even up to retirement. Depends on whatever one that was. So send me a personal message now and let's book in your free consultation so that we can start that all for you. And again, if you're watching me and you're a company director or you're sole trader, you have a business running and you don't have income protection or keyman insurance, then we need to have that conversation. Okay, all right, so that's going to be all for today. Increasing cover is the best way to have your insurance covered right now. And if you're watching this, you do not have your insurance in trust yet, let's have a conversation. I want to help you. Obviously, who would you rather have help you than the superwoman of insurance? So have a brilliant one. Share this video with others. Increasing cover covers your payout against inflation. Adjust it so that it is relevant to the period that you may be claiming, rather than what will not be enough for you, because inflation hopefully is going to go down. This is 2023. I don't know what year you're going to be watching this. However, having an increased cover gives an integrity to your payout to make sure that it is what your family is going to be able to use. Remember, life insurance, we do it not because we're going to die. We do it so that we have financial protection for the people that will live on after us. Now, income protection, our critical illness cover, are protections for you while you're alive. You need all of that. So don't get selfish. Share this. It's me again, the superwoman of insurance, and this does synergy.